Following the presentation, Governor will be joined by the bank's senior management to respond to questions submitted by the media via Slido. Without further ado, I'd like to invite Governor Noor Shamsia to deliver her presentation.
Bismillahirrahmanirrahim. Good morning, and thank you for joining us for the release of our flagship publications, namely the Annual Report, the Economic and Monetary Review, and the Financial Stability Review. The fact that this is a virtual press conference shows that this is indeed an extraordinary time. The world is going through a testing moment, and as a nation, Malaysia has already had to face a number of surprises this year. This morning, I will speak about our assessment of the economic outlook in 2020, particularly in light of COVID-19. I will also elaborate on the measures we are taking to weather this storm and the recovery we can expect. Governments around the world are taking unprecedented steps to combat the pandemic. This range from travel restrictions, bans on large gatherings, and forced business closures to blanket quarantines. While these measures are crucial to effectively slow the spread of the virus, they are also triggering supply and demand shocks. As a result, economic activity in most countries have decelerated sharply. Growth prospects for both advanced and emerging economies are deteriorating, and the IMF and many forecasters are expecting a global recession. Malaysia is one of the more open economies in the world, with trade of around 120% of GDP. As such, we will certainly feel the effects of the collapse in global demand. Already, weaker growth in our major trading partners has affected the demand for our goods and services. Disruptions in global supply chains have slowed down our manufacturing industry. Services have also been adversely affected. The movement control order and efforts to promote social distancing are crucial for public health. However, these measures have also implications on economic activity. Thus, it is certain that consumption, investment, and trade activity will be significantly affected. While COVID-19 will cause significant disruptions to the economy, the government is determined to limit its effects. The economic stimulus package introduced aims to prevent the health crisis from permanently affecting our economic potential. It does so in four ways. First, it ensures that our healthcare system and personnel are adequately resourced to combat the health crisis. Second, it gives households a financial safety net. Third, it provides some assistance to SMEs and corporates to ride out the temporary impact of COVID-19 on their businesses. And fourth, it enables viable businesses to seize growth opportunities when they arise. The immediate focus is to manage this transitory shock by minimizing permanent dislocations and long-lasting harm to individuals and businesses. In total, the 250 billion worth of stimulus measures are estimated to add 2.8 percentage points to the 2020 GDP growth. On our part, Bank Negara will ensure that the financial system continues to meet the needs of the economy. At the most basic level, this means making sure customers continue to experience uninterrupted access to basic financial services even during this MCO period. On top of that, the financial sector has stepped up to offer breathing space to their customers, especially households and businesses badly hit by COVID-19. As announced last week, financial institutions are offering loan deferments and other flexibilities for customers to preserve their insurance and takaful policies. In addition, SMEs can obtain financing when needed to sustain business operations and preserve jobs. The bank has encouraged these measures by freeing up regulatory buffers built during good times. We have lowered the SRR and given financial institutions flexibility to draw on capital and liquidity buffers. We are allowing this flexibility only because we know that the financial system has the capacity and ability to do so. Our efforts to instill discipline and prudence among financial institutions over the years is paying off. These buffers have enabled the financial sector to be prepared to mitigate the present shocks and help the economy stabilize. More specifically, banks have strong capital positions with a total capital ratio of 18.4% compared to 12.6% during 2008. The bank's liquidity coverage ratio have also increased to 148% compared to the 2015 to 2019 average of 137%. Following prudent risk management practices, impairments have remained low at 1% in February 2020 compared to 2.9% in 2008. Banks also hold provisions that can cover 125% of their impact loans. In recent stress tests, we found that financial institutions can withstand extreme shocks beyond those experienced in the past. Results affirm that both the banking and insurance and takaful sectors have excess capital that will be enough to absorb significant losses while continuing to support the economy. The developments surrounding this pandemic is continually evolving, making it difficult to predict with precision. Our current assessment is that the economic impact is within the range of shocks simulated in our stress test scenarios. We continue to closely monitor the impact of current developments on individual financial institutions. Naturally, the uncertainties surrounding COVID-19 has led to greater risk aversion in global markets. As a result, volatility in domestic markets has increased and valuations have fallen. Nonetheless, I want to highlight that intermediation in domestic financial market continues to be supported. The bank will ensure through our open market operations, which include reverse repos and purchase of government bonds, that there is enough liquidity in the system. Already, the recent adjustments in SRR and flexibility granted to principal dealers have released approximately 30 billion ringgit into the banking system. Banking system liquidity remains ample with 159 billion ringgit of surplus. This is despite approximately 25 billion of debt portfolio outflows. I also wish to point out that the adjustments in asset prices in the domestic financial market has been in line with the experience of regional peers. Malaysia's flexible exchange rate policy also provides a buffer against external shocks. The bank will continue to monitor the market and take measures to avoid excessive volatility that would disrupt trade and investments. In light of all these considerations, we project Malaysia's GDP growth for 2020 to be between -2% to positive 0.5%. In the first half of this year, spillovers from the global slowdown and our own pandemic containment measures will result in large output losses. This will take a toll on the economy, but it is necessary to keep the pandemic at bay. And at the end of the day, the preservation of life is paramount. Aside from COVID-19 related concerns, we can also expect to see continued commodity supply disruptions. The drought last year will affect oil palm yields, and maintenance works will hamper production in a number of oil and gas facilities. We are mindful that the situation surrounding COVID-19 is highly fluid, and the situation is constantly shifting. The GDP forecast of -2% to positive 0.5% is our best estimate based on what we know today. Great uncertainty remains. Beyond the measures I already mentioned, there are other factors that will help towards recovery. First, there are strengths in our economy, and the COVID-19 has not altered this fact. We do not see price pressures, rather, inflationary pressures are subdued. Our current account position of the balance of payments remain positive of around 1 to 2% of GDP, and Malaysia is still a highly diversified economy. These conditions will allow us to better face the current challenges. Second, the government is expected to continue large-scale infrastructure projects, which will provide an additional lift to growth. For 2020, we estimate that the 15 billion in capital expenditure to build major transport infrastructure will help lift the 2020 GDP growth by 1 percentage point. Third, national authorities across the world are also introducing significant fiscal and monetary interventions. This will provide some lift to global demand. Recognizing that these are exceptional times, a number of governments and central banks have already committed unprecedented amounts to help the global economy ride out the present shocks and begin the journey towards recovery once the health crisis is contained. These are trying times. I believe we have got what it takes to endure and emerge stronger. Malaysia has done this before, and we can do it again. On our part, the bank has a broad range of policy instruments at our disposal. These include monetary policy, macroprudential and microprudential policy, as well as our supervisory oversight over financial institutions. These policy tools have served us well in the past. We will continue to assess the situation as it unfolds. The bank has the flexibility and space to deploy these levers to promote monetary stability and financial stability and ultimately support sustainable economic growth. As a nation, it matters that we make the right choices now. Malaysia will need to undertake the necessary reforms so that we are well positioned to face new economic realities, especially once the global economy and investor sentiment begins to recover. This means adapting to a more digital future, especially with the expected rollout of 5G and greater fiberization across the country. We observe many firms choosing to reach their customers via digital platforms and other touchpoints during the MCO, and it will be a missed opportunity if we were to revert to our old ways. The bank has set aside 300 million ringgit for an automation and digitalization facility to help encourage greater technology adoption in Malaysia by the SMEs. We will also need to earnestly start recalibrating our national investment ecosystem. This will be important to attract higher quality investments that can yield better paying jobs for more people in the future. We have some thoughts on this matter that we published as a feature article in our Economic and Monetary Review. The article highlighted the need to revamp our existing incentive structure to be in line with the national investment aspirations while ensuring better coordination and alignment between the various agencies responsible for attracting investments to Malaysia. I highly encourage you to give it a read. As we speak, our nation's medical professionals, public health officials, and volunteers are working tirelessly to keep us safe. Bagi pihak seluruh warga Bank Negara Malaysia, kami ingin merangkamkan setinggi-tinggi penghargaan dan terima kasih kepada semua petugas barisan hadapan yang terlibat dalam menangani COVID-19. Kami turut mendoakan dan mengharapkan yang terbaik. On our part, the bank will remain focused on discharging our mandates through this challenging and unpredictable time. It is my hope that this time next year, we will be able to note that the global community has overcome this health crisis and report on how Malaysia has weathered the economic storm. For now, we will all need to persevere and come together for the sake of our collective future. Remember, Malaysia has done this before, and I do not doubt that we can do it again. Stay safe, everyone.
Thank you, Governor, for the presentation. I would now like to call Deputy Governor Abdul Rashid, Deputy Governor Jessica Chu, and Assistant Governor Marzun Nisham to join in on the Q&A session.
So can I invite the first question from members of the press?
Okay. Good morning, Governor. And thank you for all the viewers for submitting your questions. We've received a number of questions from the press today. So, Governor, question one is a truncated question from a number of members from the press. Can we confirm that Malaysia will officially be in a recession this year? What shape of recovery should Bank Negara be expecting?
Well, growth in 2020 is going to be challenging. The IMF and other forecasters are also expecting that the global economy is going to contract at a rate worse than the 2009 global financial crisis. So the Malaysian economy will be affected by the weak global demand, supply chain disruptions, travel restrictions that will affect tourism, and also the domestic containment measures. And so in this challenging environment, we do expect that growth to range between -2% to plus 0.5%. In terms of the shape of the growth in the first half of this year will be significantly impacted by the output loss of the COVID-19 pandemic, the movement control order, and continued supply disruptions. While economic activities is expected to resume when the MCO is lifted, demand conditions are expected to remain soft as travel aversion and social distancing will continue. Globally, as the COVID-19 pandemic is still evolving, travel and movement restrictions may well continue in several countries, including advanced economies. And production shutdowns will also result in prolonged disruptions to global supply chains. This will continue to dampen external demand for Malaysia's exports. However, we expect growth to gradually improve in the second half as the impact of these factors, which is significant but temporary in nature, begin to dissipate. The substantial policy responses from fiscal, monetary, and financial policies will provide and add 2.8 percentage point to growth. The OPR cuts will also provide support to growth. Improvement in domestic demand especially from pent-up demand in travel and tourism activities, will also support growth. In addition, the continuation of large-scale infrastructure projects such as MRT2, LR33, and Pen-Borneo Highway will provide an additional lift to growth of about 1 percentage point. The bank expects the Malaysian economy to rebound in 2021, in line with the projected global recovery. There is great uncertainty on the outlook. The situation is still evolving, and the bank will continue to monitor and assess the development of the pandemic and its impact.
Governor, if I may add, there are also both upside and downside risks to the outlook. Downside risk stems from the prolonged and wider spread of COVID-19, both globally and domestically, the recurring commodities supply disruptions, tightening financial conditions following the heightened volatility in financial markets. However, there are also upside risks coming from larger than expected impact from the pro-growth measures, faster normalization in activity amid pent-up demand, as what Governor mentioned just now, better than expected global economy arising from the various stimulus measures, and better than expected commodity production. These upside factors also explain how growth can end up at the higher end of our forecast range. I should also mention that growth forecast in Malaysia and globally is dependent on the magnitude and duration of the pandemic outbreak. We have not experienced anything of this scale since the Spanish flu in 1910.
Thank you. Another question that we've received from The Edge is, what are the assumptions underpinning our growth forecast?
So I'm going to flash this chart that underpins our assessment as to how the pandemic may evolve. So our forecast of domestic growth relies on the assumption of how the pandemic will evolve. The forecast assumes economic activity will be impacted by the measures to contain the spread of the virus and the impact of the lifting of these measures later and the policy stimulus. The growth forecast assume a contraction in the global economy as a result of the unprecedented measures taken in the affected countries, which are our major export markets to contain COVID-19. Syamil, you want to add?
Thank you, Governor. In addition to the two key assumptions that the Governor mentioned, we also have several other assumptions that we build into our forecast. The first is that with respect to commodity prices, we assume that oil prices in particular will be between 25 to 35 US dollar per barrel for 2020. In addition to that, domestically, we also incorporated the impact of the MCO for the 4 weeks movement control order. In this MCO assumption, we actually expect that the economy will be operating around 45% of its capacity. In the first half also, we expect that some continued supply disruptions with respect to the oil palm productions as well as in the oil and gas sector. So as Governor mentioned earlier, the first half would be rather weak economically, but with the economic stimulus measures as well as other infrastructure projects that are ongoing, we believe that we could see some improvements towards the later part of the year. Governor, if I could also touch briefly on the labour market. There have been some questions on this, some interest on how our labour market will be impacted by these significant and unprecedented measures that have been taken to contain the outbreak. Yes, we expect the labour market to be considerably weaker. We expect the unemployment rate to increase to about 4% of 4%. In comparison, during the global financial crisis, our unemployment rate was at 3.7%, while during the Asian financial crisis in 1998, our unemployment rate was at 3.2%. Let me make 2 points. The first is that the stimulus package is intended to assist the workers, the households, and the businesses to go through this difficult period. We want to avoid a permanent impact on the businesses and workers. This way that once the COVID-19 outbreak is brought under control, businesses and economic activities can resume. Secondly, the faster we contain the outbreak, the faster the businesses can resume their operations and rehire workers. So that would help to keep our labor market to recover faster. Thank you.
Ishak, any further questions?
Yes, we received a question from Rita Harian and The Edge. Do we have the policy space to tackle this pandemic and maybe to embark on a larger stimulus? More specifically, the question alludes to fiscal policy space.
The bank has a range of policy instruments at our disposal to cushion the economic impact of COVID-19. The monetary policy stance is already accommodative, and decisions on monetary policy will continue to be guided by the evolving risk to growth amid price stability. Alongside monetary policy, we also have our supervisory function, our macroprudential and microprudential policies that form part of our policy arsenal. And we will use this policy instrument flexibly and when appropriate. And as demonstrated in the recent economic stimulus package, the bank's policy will complement fiscal and other policies of the government. Ultimately, the aim is to mitigate the impact of COVID-19 on the economy and avert large-scale and lasting impact on businesses and the economy.
Governor, if I can add on the fiscal policy, the economic stimulus package that Governor mentioned earlier, I think they are temporary and also time-bound. And the government has reiterated its commitment towards the medium-term fiscal consolidation and reforms. I think the gradual fiscal consolidation over the years has actually allowed the government to rebuild some fiscal space to support the economy during periods of economic slowdown. For example, since embarking on the fiscal consolidation in 2010, the fiscal deficit has declined by half from minus 6.7% of GDP in 2009 to 3.4% of GDP in 2019. Thank you, Governor.
The following question comes from Bernama and Bloomberg. Both Fitch and Moody's have in recent days revised Malaysia's banking sector outlook. What are your views on this revision, and are there longer-term risks to financial stability, particularly given the loan deferment moratorium?
Firstly, I should mention that both Fitch and Moody's assign a negative outlook to all banking systems in the Asia-Pacific region, not just Malaysia. We are facing an unprecedented global situation, and the COVID-19 pandemic is affecting almost everyone. Regardless, we need to acknowledge that recent developments surrounding COVID-19 have increased the risk to financial stability. However, I must also emphasize that Malaysian banks are also now much more resilient to this risk. Maybe I can get Jessica to add a few points on this.
Right, so banks are certainly much more well positioned to continue to support lending activities and the overall economy in this environment. Few points. Firstly, banks have strong buffers that have been built up over the years. The aggregate excess capital buffers of the banking system, this is the size of additional buffers that they hold above the regulatory minimum. That is currently at 121 billion ringgit. These are actually additional capital resources available to banks to absorb losses and also to continue to support lending activities. Secondly, banks also hold ample liquidity buffers, which is more than sufficient to withstand outflows under stress conditions. In fact, this is what has enabled banks to provide the moratorium on loan repayments that were announced recently while continuing to support lending activity. Thirdly, I think it's important to also recognize that banks have adopted sound risk management practices. In fact, the impairment levels of the banking system now are at around historical lows, currently at 1% of total banking system loans. Now, banks have set aside provisions against these losses, and they've set aside, in fact, more than adequate provisions. So while we do expect that given the weaker underlying conditions, there will be households and businesses that will face some repayment difficulties, we do expect that any increase in credit losses from the current low levels will be well within the capacity of banks to absorb. And this will be without impairing credit flows to the economy. I also want to note that most households and businesses have demonstrated adequate and reasonably healthy debt servicing capacity prior to the outbreak of COVID-19. For households, our estimates of households that are most vulnerable, those with negative financial margins, are about 5.2% of total household debt. And for businesses, most businesses have earnings buffers of over 4 times their debt servicing obligations. So the measures that were implemented, including the loan moratorium and the funds that we've made available to SMEs, will provide the temporary relief to borrowers so that they can recover from the current difficulties with greater prospects to maintain their debt servicing capacity once conditions improve. Now, this is what will help limit the potential increase in credit losses to banks. So in the FSR, the Financial Stability Review, we've provided details on various stress and sensitivity analysis that we've conducted to assess the resilience of households, of large businesses, as well as the banking system. And they show that the system as a whole, and banks in particular, are resilient to the current challenges.
Thank you, Jess. Am I being too optimistic to think that that would be the end of the questions?
On that note, actually, we have a question from Bloomberg and The Star. In our stress testing that we've undertaken for the financial sector review, have we incorporated the impact of the current adverse developments, i.e. COVID-19 and weaker growth conditions?
Well, although the unfolding developments surrounding COVID-19 have been unprecedented, the economic and financial impact of these developments are within the range of shocks applied under the adverse scenarios in our stress test. We take the resilience of our bank seriously, which is why when balancing between conservatism and realism in our shocks, our stress parameters will always lean towards being more conservative. For instance, the adverse scenario were deliberately designed to be severe with low likelihood to occur. Scenario 1, for example, simulates a recession more severe than that experienced during the global financial crisis, while scenario 2, if you look at our FSR, simulates a GDP growth path that Malaysia has never experienced before. And secondly, the stress test does not include any additional policy intervention by authorities. Neither has it included probable management actions by financial institutions themselves. In reality, if these stress scenarios materialize, both the banks and authorities will take mitigating actions that will improve bank solvency. And lastly, we allow for organic capital growth only in the stress test through the accumulation of retained earnings. So we did not take into account the probable capital injection by the shareholders.
If I can just add, for households and businesses in particular, just to illustrate the level of stress that we applied. So for large borrowers, we applied an earnings shock that was double the shocks that we experienced during the global financial crisis. While for households, the income shocks that we've applied were also higher than that experienced during the Asian financial crisis. And we also combined that, we have a box article in the Financial Stability Review. We combined an income shock to households with a house price shock that is more than double our historical worst experience. So overall, I think the various exercises that we've conducted do show and underscore the resilience of the financial sector to potential large losses. And this is really because of the strong buffers that they have built, and as well as the sound underwriting and lending standards that actually underpin the asset quality of banks.
Okay, we've got one more question here. I'm sure it's close to everyone's mind. Would the loan payment deferment be extended if the impact of COVID-19 continues? What alternative measures could be introduced?
Well, we just introduced this comprehensive series of measures last week, and that includes the moratorium and regulatory reliefs. And this measure came into effect only 2 days ago, so it's too early for us to talk about extending the moratorium. So the financial institutions themselves, even before we announced this moratorium, we have been working with the financial institutions to see how best do they come to help the borrowers and customers during this very challenging environment. So let's just concentrate on implementing these measures, and we will closely monitor the situation and assess the need for more measures with the financial industry. So I think we will perhaps stop here with the questions. I am aware of the constraints and limitations to have active two-way conversation in this medium. Certainly, this is one example where we can benefit from a faster rollout of 5G technology. So I would like to encourage all of you to send in your questions to us via email, and we will provide responses maybe in the form of Q&A on our website. And before we end this telecast, allow me to say a few words. Firstly, these are extraordinary times in Malaysia and in fact in the world. All of us at the very basic level are either a mother, a parent, a child, a sibling, a spouse, and all of us are worried about the impact of this virus on the health of our family. So the faster we can flatten the COVID-19 curve, the faster we can speed up our recovery, the faster we can revert to our normal lives. So each and every one of us can do our bit. Please observe the MCO and please stay home. Secondly, we need private consumption to recover, and so I encourage everyone to spend wisely and prudently. Thirdly, earlier we spoke about investment, digital economy, and recovery. And those three are encapsulated when we look at businesses seizing opportunities via digital technology during the MCO. And as we adapt to life post the pandemic outbreak, I envisage greater leveraging of technology in the way we live, we work, and play. So I encourage businesses to maximize the bank's 300 million ringgit automation and digital facility. Lastly, on behalf of the bank, I would like to thank all the medical and security frontliners who are working tirelessly to keep us safe. Our thoughts and prayers are with you. Stay safe, everyone, and thank you.
boleh digarapkan dan boleh dihasilkan dan boleh dituralkan dalam masa sekejap mata. Dan ini amat berbahaya kerana apabila berlaku salah satu proses yang boleh mengakibatkan ancaman keselamatan kepada negara, boleh mengakibatkan ancaman kepada perpaduan kaum, boleh menimbulkan ketakutan dan kegetaran pada masyarakat, maka ia akan menjadi salah satu proses perkongsian